Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Mike Larson, and we are chatting just a couple hours before the Fed statement and press conference. So as much as we might talk about Fed policy and potential rate cuts, we don't know what's going to be said from Powell today, but we're all kind of expecting another hold. Who knows whether it's going to be commented on dovish or hawkish. Either way, we're going to try to avoid simply predicting what's coming in a couple hours. We are going to talk about what we saw in terms of inflation data and some of the market moves as well as commodities. So Mike is the editor-in-chief at The Money Show. I will post a link in the show notes to the Money Show website. Mike, let's just quick start off with broad overview of, I guess, the inflation data from earlier today, which has pulled the dollar back. The dollar was really running, and markets, at least a select few stocks have been holding up these markets. At least that's what we've been hearing a lot about. So first and foremost, let's just talk about your assessment of that inflation data, please.
Yeah, sure. I think the scary headlines about inflation, the sort of doom and gloom on the inflation front is really behind us, right? I mean, we've seen steady progress. It's not fantastic. We're not exactly where the Fed wants to be, but we're certainly heading in the right direction. I mean, you look at the data that came out, it was just like, it reminded me of, was it Animal House, where Blutarski comes in and they say his grade point average is 0.0. Well, that's what we got on the headline CPI. No change at all in May. Core CPI was up 0.2%, and that was a tenth cooler than expected. And some great analysis I saw. I love following smart economists on Twitter so they could do the work that I don't have to. Liz Young Thomas is one I follow, and she pointed out that the super core, which, is the let's exclude everything and see what inflation is kind of thing, as silly as it may be in real life, it is something the Fed looks at. And that was actually down 0.04%. So if you look at the sort of strip out a lot of this stuff and then really in the nitty gritty, what's the super core doing? It was even down a little bit. So look, I mean, again, that's different from what we care about in our real lives, but it is something policymakers look at. And it does kind of confirm that we're on the right track in inflation, even as we've probably got more ground to cover here. So in this scenario, I think it does lay the groundwork for the Fed to take back some of its tightening, to ease a bit. I certainly don't think we're going to embark on some radical rate cutting cycle or whatever. Back in January, there was a lot of talk. The markets were pricing in 6-7 rate cuts, which I thought was aggressive back then. About a month or two ago, the markets were deep. We were talking about no rate cuts, because some of the Fed news was inflation news was a little more bearish. But all in all, I've had this narrative or this thought, thesis, whatever you want to call it, that we'll see 1 or 2 cuts from the Fed this year, probably in September and December. And I haven't really seen any reason to change that view, whether it was early on when the talk was of a lot more cuts or later on when the talk was of no cuts. I said back then when we were talking and people were kind of worried about inflation, I said, look, the Fed's hurdle to restart a hiking cycle, in my opinion, is much, much higher than the Fed's hurdle to start a cutting cycle. I mean, they get another month or two of tame inflation data, and I think that's all they need to see to cut, or they continue to see what's happening in the labor market, which is nothing terrible, but we are seeing, claims start to tick up. We are seeing unemployment start to tick up. Even in the most recent jobs report, where the employer survey showed a stronger than expected gain in jobs, the household survey actually showed 400-some thousand jobs lost. So you're seeing, you're seeing it get back to a sort of looser market versus the incredibly tight one we had for labor, and a okay inflation environment versus the really bad one we had a couple years ago. I mean, we have to keep in mind, you get headline CPI at the absolute worst in 2022. I think it was June or July, I forget which month, June if I'm not mistaken. It was 9.1%. This month in May, it was down to 3.3%. So we've come a long way when it comes to improving the inflation situation. And that's what the Fed wants to see. And I think it's going to give them enough leeway to cut a little bit modestly. Again, I think this isn't going to be like some huge thing where we're talking about 2% interest rates early next year or anything like that. But, somewhere in the mid 4s, I could see that happening.
Yeah, some solid points there, Mike, because it seems like the markets always go to extremes on either side. Either there's going to be 7 rate cuts this year or no rate cuts this year. But reality is we probably see 1 or 2 from the Fed later in the year. And it's in line with what the Bank of Canada just did, what the ECB just did. And a 25 basis point or a 50 basis point cut is really not going to be the end of the world. It's not going to change things that much. But coming into this year with those expectations, the markets rallied in the famous Powell pivot party. but they've contained that enthusiasm throughout the year. And really, the markets have done incredibly well, breaking out to all-time highs. Now, we have had some comments to Corey's point in the onset that some of that is kind of focused into the narrow mega cap tech leadership again. We've seen NVIDIA speculation moving higher and higher, but the rest of the market breadth hasn't been as good. But we hear a lot of bearish comments on that too, or people on the bullish side that think NVIDIA to the moon, and it almost has been. But your approach, Mike, is always middle of the road, and you're looking at things practically. And I asked you on the just talking to you off mic, are you looking at the rest of the market breadth to kind of catch up to this trade, or are you looking at the tech leadership to roll over? And you said you were on the catch-up side of looking at things. Maybe talk to us about how you expect the rest of the market to interact now with the indexes.
Yeah, sure. Let me see if I can cover a few of those questions in order. You first brought up the issue that non-U.S. central banks have been starting to cut rates, and you're right. You had the Bank of Canada with a 25-point cut. You had the Swiss National Bank that cut. You had the ECB that did a little cut here. And look, I've been following the sort of central bank policymaking world for a quarter century now in various capacities. And these guys, let's not kid ourselves, behind the scenes, they're talking to each other. They're kind of mapping out what they plan to do and back channel talk and everything. So the fact that foreign central banks have started to cut gingerly, I mean, if there was any other reason they needed for the Fed, you needed to start cutting, they got it again. The Fed doesn't want to be way behind the curve. I think these tentative steps elsewhere are going to be driven by some of the same trends that allow the U.S. Fed to cut. So I think I put on Twitter after the BOC announcement, I said, the Fed is guaranteed to cut this year. It's going to happen probably in September to start this process. And I think, again, if anything, the inflation news that came out really just solidifies that view. So yeah, I think the Fed follows what a couple of the foreign central banks have already done. As far as your question about market breadth and what happens next, I was joking, just call me Heinz 57. I think this is a catch-up market, right? We're going to see the things that haven't moved as aggressively, anywhere near as aggressively as tech has, begin to play catch-up. That being said, I would also say it hasn't been terrible in the rest of the market. I mean, you've got things like REITs that are just continuing to languish there because of all the issues with commercial real estate, and you can't go by a day without reading about some office building that used to be worth $200 million that now is worth $100 million or $50 million or whatever. So you got some issues with the REITs. They're still facing questions about what's happening in commercial real estate and office and apartments. You've got some sectors, defensive type sectors, that haven't been performing very well. But in general, if you look at financials, if you look at industrials, if you look at to some degree transports, I mean, they're not as great as tech, but they're certainly not terrible either. Ironically enough, up until maybe a week or two ago, utilities were even outperforming tech. So go figure. Now, some of that is actually a tech leveraged trade, people buying utilities as a way to profit from the fact that AI, data centers and things like that are going to use so much power that they're going to drive up earnings and sales for utilities, the traditionally defensive sector. But all in all, it's not terrible in the rest of the market. It's just not great. And even that, the right data could ignite that sort of catch-up trade. I mean, on the morning that the inflation data came out, what happened? The Russell 2000 ETF shot up 3% as soon as the news hit the tape because people are looking for the next thing, the next sort of trade to make beyond tech. As far as the tech situation and what's happening with these mega caps and are they overvalued and is it just a few stocks leading the market? All I would say to that is you and I talked back in 2021 when I was saying all this tech ridiculousness at that time, all these .com idiotic companies, money-losing tech companies, SPACs and things like that were doubling and tripling in a day. That looked like a massive bubble to me. That I thought was dangerous, and I said it was. And sure enough, what happened? The tech market, some of those companies went out of business. Many of them lost 40, 50, 60% of their value. And big tech got hammered 20, 25, even 30% in some cases. So if you're looking for a tech boom and bust or bubble and bust, you already had it in 21 and part of 22. And so now I think the survivors of that, one of the reasons these companies are doing so well isn't just AI mania or AI catalysts. It's that you already had these companies get killed when you had a mini .com crash. So I think that lasted many months. It wasn't just a thing that happened over the span of a couple of weeks. So I think that it's, when you talk about this market, and this is almost always the case, right? You can find some things to quibble with. You can find some things to highlight that are bearish, but for every one of those, I'll turn around and say something bullish. I mean, just this week, you look at what happened with Apple, right? It was the one kind of big tech name that was just sitting there. Oh, they never come up with anything new. It's stodgy. It's not worth it. It's holding the market back. You just have companies like NVIDIA that have like the sizzle to them that are doing well. what happens? Apple comes out with this developers conference, announces some AI stuff, Apple Intelligence, whatever, and it seems kind of hokey. People buy into it, and the stock's up 7% in a day, and it gains like $300 billion in market cap in a couple of days. So that's a situation of people chasing what had been a laggard, looking for new winners, even within the tech sector. So as long as that's the case, again, I think generally speaking, it's still a be bold market environment. I still think that you want to be looking to pick and choose some of these other places. And I'm sure we'll segue into it shortly, but I also think that this Fed news, or my expectation for the Fed, means the dollar is going to roll over again. Treasury bonds, Treasury bond prices are probably going to go up. Yields are going to come down. And that's going to help things that, in the commodities space. So, and even maybe emerging markets, some of these things have been left for dead. So I think this is a market that offers a pretty decent list of ways to win. It's not one that to me looks ridiculously overvalued or overhyped or whatever. So steady as she goes, in my opinion.
Mike, let's talk about some of those potential correlations to the dollar or to interest rates, because it is something that we actually have seen a little bit in the past where the dollar moves up and the market sometimes gets a bit more concentrated. It's almost a defensive play, maybe. That's a big question mark. But the dollar, it's moving down quite a bit today. And we could be arguably seeing a bit of a broadening out in this trade. Again, this is just a couple hours of trading. But carrying that over, you mentioned commodities. Commodities had a wild ride in May. And the last time we chatted was mid-May. Copper went almost straight up and then gave back most of those gains. Precious metals, they've been flat. Silver's been a little bit weaker than gold. Where do you see the best opportunities in the commodity sector?
Yeah, you're right. It was wild. After a huge run in gold, we got over 2,400. Silver was jumping by leaps and bounds, multi-year high there. Copper, obviously, all-time high, and then the reversal. I think that was some froth coming out of the system, whatever you want to call it. But, to me, it doesn't look like one of those blow-off absolute tops that, you don't see again for a year, 2, 3 years, whatever. It didn't look to me like the end of this bull run. It looked to me like a shorter-term sort of exhaustion moment that now we're digesting, right? And I think that, again, part of it is because you got these headlines, China's not buying gold anymore after they've been buying gold for months and months, and copper, it's been EVs, but maybe EVs aren't going to be as much of an energy transition. It's not going to be as much of a thing. So the narratives are kind of battling it out, and people saying, silver is just another one of these like sort of mini bubbles people are jumping on, and then as soon as the tide turns, they're going to jump right back out. But I think if you look at some of the overarching trends, improved Chinese economic data, not great, but not terrible. You look at a Fed that if it truly is going to start cutting a little bit, modestly, whatever, that is going to take the knees out from under the dollar's recent bounce. A lot of these things, I think, argue for staying long commodities. I mean, again, it is baseball season, so I guess if I still want to talk about the bull market, things like gold that's been going since the second half of 2018, I still think we're maybe kind of in the sixth inning of this thing. I don't think this is the end. I don't think this is, again, what happened more recently is some big blow off top. I just think it's working off some overbought conditions. So I think you stabilize there. I mean, again, depending what the Fed follows up today's meeting with in July and or in post-meeting speeches, I don't see why they would talk a tough game. I don't think the Fed, by and large, the central consensus wants to be driving a hard bargain when it comes to interest rates and driving them up and keeping people on their toes. I think they're getting the data they wanted to get. As long as that's the case, they're going to have a cut or two in their back pocket. So all that, again, I think that is bullish for commodities, bearish for the dollar. And I think within that universe, I still kind of lean towards precious metals, especially after the big move you had in copper. So, I mean, I would be buying the dips that we've had in gold and probably especially silver. Some smart people that I listen to and follow are more bullish silver now than gold. They think there's more, to use the catch-up analogy again, there's more catch-up to be done there. And I don't think I can argue with that. Then there's even parts of the commodity market. Our good friend Sean Broderick's talked a lot about natural gas lately. It's a forgotten energy commodity that maybe is getting unforgotten and is starting to perk up after having a really terrible stretch of performance. So things like that are probably worth looking at. And again, I think the generally bullish environment for that part of the market is intact and is likely going to remain that way for some time.
Just as it relates to the commodities, how important is the energy story that you brought up earlier as far as these AI data centers requiring so much more energy, same with EV charging stations or just the developing world getting more electricity? Did that play into the recent run we've seen in copper or silver for solar panels or uranium or nat gas? Because the world's going to need more power for all this tech. And do you think that's a sustainable trend in the commodity space?
Yeah, I think it's a great long-term story / narrative that in my opinion, I think has merit. It's not one of these things people just cook up to justify why they made 5% in a day on copper or silver or whatever. I think it is legit. It is one of these things that we have to have a more resilient grid. We have to have more power to fuel these things. I mean, if money's going to be invested in that, money's going to be in private money in the case of tech, public money in the case of infrastructure, and so on. That's a lot of money being thrown at a sector to improve reliability and supply and so on in the utility space. So yeah, I like it. And I mean, the dividends aren't bad to boot. So there's definitely some companies in there. Some of our contributors have highlighted a few names that it goes back to the old picks and shovels kind of argument. Do you want to buy the companies that are leading the California gold? I think there's a case to be made for both on some level, but in some cases, depending on your timing, you can make more by focusing on the picks and shovel guys.
So Mike, I guess broadly, it does still seem like a good market, right? As you said, be bold, right? Go out there, make some investments, have your money at play, even though people can put some money away in safe investments like a 5% money market fund. Quite frankly, you're seeing better opportunities in a wide range of sectors.
Yeah, I mean, look, again, I have no problem with being bearish when I need to be. I have been at times in my career extremely bearish. I mean, take it back to the housing bubble, mortgage, all that craziness, all this going on. I mean, every time I got on TV or on the radio, I was talking about how this whole thing was going to fall apart and you get your money the hell out of the way. But I don't think that's the case these days. And my goal is to not like cling to some kind of whatever notion or try and find reasons why I'm right about something that I'm probably wrong about. It's to look at the markets, look at what's going on, and look at ways to make people money. That's what I'm here for, and that's what I plan to stay here for. So yeah, I'd say it's still in that sort of split between being bold and being boring. And this is still a case of a bold market, a be bold market, and I don't see that changing in 24.
Okay, Mike, enough said. I really do appreciate your comments here because during that bear market, you were saying that people need to get defensive, just hit singles type of thing. And now there is this better environment out there. As much as the bears want to point to select information that says that maybe these markets are bearish, quite frankly, you're seeing a lot of opportunities out there, and you've been calling these markets very well over the last number of years. So I do appreciate your time, and I appreciate all of your insights. Again, I'll post a link in the show notes to the Money Show website. That's where you can follow along with Mike and check out some of the upcoming conferences. Mike, thanks as always for your time.